You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
This is the Options Industry Council's Wide World of Options. Before we start today's show, listeners should know that options involve risk and are not suitable for all investors. Individuals should not enter into an options transaction until they have read and understood the disclosure document, characteristics and risks of standardized options, available by visiting the OCC.com or by contacting your broker, any exchange on which options are traded, or the Options Clearing Corporation at 125 South Franklin Street, number 1200, Chicago, Illinois, 60606. The Options Industry Council is an industry resource provided by the Options Clearing Corporation, collectively OCC. Any strategies discussed are strictly for illustrative and educational purposes only and are not to be construed as an endorsement or solicitation to buy or sell securities. Commissions, fees, margins, interest, and taxes have not been included in any of the examples used in this show. These costs impact the outcome of all stock and options transactions. Consult your tax advisor about any potential consequences. OIC was created in 1992 to educate investors and their financial advisors about the benefits and risks of exchange-traded equity options, and the Wide World of Options radio show is one of several resources investors can utilize to learn more about options. Other resources OIC offers include webinars, articles, and self-guided options-related coursework. For more information, check out www.optionseducation.org. Now, here's your host, Mark Benzaquen.
Hello, everyone, and welcome to another episode of OIC's Wide World of Options. My name is Mark Benzaquen, and joining me once again in the studio today is my colleague, Ken Keating, a 25-year options veteran with roles ranging from market maker, risk manager, portfolio manager, amongst others, and now a fellow options instructor here at OIC. Ken, welcome back.
Thanks, Mark. I'm happy to be here.
So, Ken, I was talking the other day with a longtime options investor, and they were surprised that they were assigned on an out-of-the-money short put. After discussing the issue with her, I realized that in many cases, there's more than meets the eye when it comes to exercise and assignment, specifically when it comes to early exercise, trading halts, after-hours trading, things like that. So with that in mind, I was thinking we might have a discussion about exercise and assignment in general before zeroing in on these unusual cases. How does that sound?
That sounds great. Let's do it.
All right, so let's start with the basics for those listeners that might be new to options. Ken, give me a high-level overview, if you would, as to the exercise and assignment process and how it works.
Okay, well, just to start with, for options holders, so basically we know that options buyers have rights and option sellers have obligations. So anybody who owns options owns the right, in the case of calls, to buy that security on or before expiration at their strike price, and in the case of puts, has the right to sell that security on or before, at their strike price on or before expiration for whatever reason they want. Now, the seller, on the other hand, has the obligation to fulfill the terms of that contract. So in the case of somebody who short calls, if they are assigned, they would have to deliver stock. They would be paid their strike price times 100 and have to deliver shares to the exerciser. And in the case of short puts, they would have to pay their strike price times 100, and they would receive 100 shares per contract of that security. So exercise and assignment in terms of, once again, buyers have rights, sellers have obligations.
So the way that those rights are enacted and the way that those obligations are fulfilled is the exercise and assignment process.
That is correct. That is correct.
Okay. And typically investors would only choose to exercise their contracts deemed to have value at the time of expiration, and that's what we call being in the money. And to streamline the process, OCC created a mechanism to automatically exercise those in the money contracts, right? What is that process? So
this is a process called exercise by exception. And what that means is it's more of an administrative convenience for our member firms where contracts that are deemed to be a penny or more in the money at expiration are automatically exercised. Now, different brokers might have different exercise thresholds that might be greater than a penny. So you'll certainly want to reach out to your broker to find out what exactly that threshold would be as it applies to you, if it's different from the 1 penny. But as I mentioned before, as an administrative convenience, exercise by exception is a penny or more in the money, and it's a convenience that is that we extend to our member firms.
Okay, so that addresses the issue of exercise at expiration. But we also know that with an American-style contract, such as equities, for example, buyers can exercise at any time. And this is something that Roma and I discussed during our last podcast, early exercise in the face of a dividend. And that's kind of an unusual circumstance or kind of outside the box, under the surface, if you will, outside of a normal expiration exercise process. So let's talk about early exercise. What are your thoughts on that?
Sure. So in the case of American options, they can be exercised at any time that the holder wishes. That's on or before expiration. But keep in mind that anybody who decides to exercise early, there has to be an economic incentive to exercise early, because by exercising early, you are, in a sense, accelerating your expiration. And by doing so, any time premium in that option would be foregone by the long holder, and it would accrue to the seller. So in the case of a dividend, let's just say your contract expires in 1 week, and maybe you're long the 45 call, the stock's trading 55. So it's $10 in the money. And maybe it's trading for $10.10. There's 10 cents of extrinsic value or time premium in the option.
And that you would lose if you exercise
it. Right. But let's just say that tomorrow that stock is going ex-dividend for 50 cents. So remember that only stockholders are entitled to dividends. Option holders are not entitled to dividends unless, of course, they exercise their contract and take delivery of the shares.
And become a stockholder through that process.
Exactly. So in this case, because the dividend is greater than the amount of the time premium in the option, in this case, 50 cents is greater than 10 cents, there's an economic incentive for the option holder to exercise their long contract. In a sense, they're going to forego that 10 cents, but in return, they're going to receive the 50-cent dividend. So anybody who short that contract, if you have a covered call situation on where you're short that call and long stock against it, and because the dividend is greater than the time premium that option is a strong candidate to be exercised early for the dividend. So knowing that, if you have interest in receiving the dividend, you're going to have to buy that call back in the open market, maybe roll it to a higher strike price to avoid early assignment. But there in that situation, there's an economic incentive for the call holder to exercise early.
So one way to make that determination as the call holder, whether or not you should exercise early, is looking at the time value in the option versus the amount of the dividend.
Correct.
Last podcast, Roma and I also talked about something that traders look at, that market makers look at, and that's looking at the value of the put rather than the value of the call. Walk me through that, if you would.
Well, there's something called put-call parity. So options that share the same strike at the same expiration have a direct relationship to one another. So in the case of that 45 call that's $10 in the money, that call had $10 of intrinsic value and 10 cents of extrinsic value or time premium. Well, the 45 level put, which would be out of the money, should have roughly about the same amount of extrinsic value as the call, okay, for put call parity to hold. So the put should be trading roughly around a dime, okay? Maybe the market on its nickel bid at 15 cents, but roughly it should be about a dime. So as I mentioned before, there is a direct relationship between calls and puts that share the same strike and the same expiration. And if that relationship is violated, there would be an arbitrage opportunity. And because markets are pretty efficient these days, those opportunities wouldn't last very long.
Okay. So the early exercise, while it's kind of outside the box of your typical option contract, it's definitely not something that is rare. Dividends happen all the time, and there's early exercise is typically a result of that for those in the money options that you talked about. But now let's go even further beneath the surface, and let's look at a couple different circumstances in which they may be more rare, maybe more unusual, and certainly something that may be more of a surprise to call or put holders that they may not be expecting. So in our previous podcast, we had talked about how about 72% of all options get closed out ahead of time for expiration. And really the idea with most investors when it comes to options is they're actually not looking to buy a call and exercise it and become a stockholder. What they're really looking forward is that price appreciation of the option. The problem is they can only realize that price appreciation when they sell that contract to close. But if the underlying stock is halted and therefore the options are halted as well, the investor isn't going to be able to close out their position, which only gives them two scenarios left. They can either exercise it or let it expire regardless of its value. So let's talk about trading halts and assume that, for an example, let's say I'm an investor, I'm long puts, the underlying stock is halted. Where do I go from here?
All right. So from OCC's perspective, the Options Clearing Corporation's perspective, we don't put exercise restrictions on long holders. So the right of the option holder is still in place. But it's really important that you don't confuse the right that you hold and your ability to fulfill the obligation. So a perfect instance is, let's just say your stock is halted and you were bearish on a stock and the stock went lower and it halted. And maybe there's some irregularities about the company, accounting, earnings, some news comes out.
Government interference, foreign policy.
Exactly. So all of a sudden, you own the put. You made a calculated decision to buy the put in a speculative sense
because you thought the stock was going to go down,
and the stock did go down. So you're on the right side of that trade.
Seems like a winning deal,
right? But now the stock halts, and maybe it's halted for days, weeks, in some instances months. And let's just say your expiration is in a week and the stock is still halted. Now, you certainly own the right to exercise that put. In other words, you would be paid your strike price times 100, regardless of where that stock may open, but you are still obligated to deliver those shares.
Right.
So if you don't have the physical shares to deliver against your long puts, your broker might not allow you to exercise those puts if, one, they can't borrow the shares and let you carry the short position. Because remember, if you exercise a put and you don't have the physical shares to deliver against them, you're going to be essentially naked short the stock. And if it's a hard to borrow situation where there's no stock to borrow, your broker might not allow you to exercise that put for operational risk, or maybe your account's not big enough to carry that position for whatever reason, or the stock's just not borrowable. So in that case, if your broker doesn't allow you to exercise and that put, your expiration comes up, and that put, any option that doesn't get exercised come expiration, regardless of how much is in the money, would expire without value.
Right. And this is something that we've seen recently with some of these foreign stocks that the U.S. government has put on certain mandates, certain restrictions. And these put holders, they had the right idea, as you had mentioned. They were bearish on it. They thought that the stock was going to go down. It did.
Right.
They tried to exercise because the shares are halted. The trading firms may not be able to locate these shares in order to deliver to the assignee, or if they are able to deliver these shares, they're going to charge a very, very high interest rate or margin rate for these put holders. So it may make it financially unviable for these put holders to exercise. So the important thing here is that the put holder still has the right to exercise their contract, but part of that contract is their obligation to deliver the shares if they exercise.
Correct.
If they can't fulfill that obligation, then it stands to reason that they're not able to exercise.
They might not be able to exercise.
Right.
Now, if the stock reopens, then it doesn't matter, because if the stock reopens, the options will reopen, and then the investor could take their profit by selling the put, or they could just go out in the open market and buy the physical shares to deliver against puts that they want to exercise. And then it's not an issue. But we're talking about when the stock is halted. It's not, if the stock's halted, the options will be halted as well. And it may be an issue if you don't have the physical shares to deliver.
Okay. And I'm assuming if the stock is halted and OCC can't come up with a value for the underlying shares because they're not trading in the market, then that automatic exercise process that we talked about earlier, that's going to go out as well, right?
Correct. So because that if a stock is halted, there's no telling where that stock may open when it reopens, if it reopens. And because of that, investors have to make an independent determination of whether they want to exercise their contracts or not. So contracts are not automatically exercised. So OCC puts out a list of securities that have been removed from X by X processing. That memo comes out on Tuesdays, every Tuesday of the week. And it's a list of securities. You can go to the OCC website. Just take a look at that memo. It comes out every Tuesday of securities that are on that list. But if one of your securities is on that list and has been taken off of X by X processing and your expiration comes up, once again, you would have to make an independent determination whether you want to exercise or not. So if you chose to exercise, you would have to do so manually through your broker, through what is known as a contrary or contra exercise notice. You would have to manually exercise those contracts. You cannot assume that those contracts would be automatically exercised, regardless of how much in the money they were at the time of the halt.
Okay, excellent. So while they still retain the right to exercise, the investors may not have the ability to do so for one reason or another. So certainly something that they should be discussing with their brokerage or trading firm if they do find themselves in this scenario.
Absolutely.
Okay. Let's get into our last point, which deals with after-hours trading. And let's assume that I'm short $50 calls. Stock closes $49 on expiration Friday. Now, normally one might assume that I'm safe from assignment as my calls expired out of the money, or I should say calls are deemed to be out of the money based on that closing print. But I'm not necessarily safe from assignment, am I?
Right. So once again, the only way to truly avoid an unwanted assignment is to buy any contracts that you're short, you're at risk of being assigned on.
Mm-hmm.
So the only way to mitigate against an unwanted assignment is to buy that option back in the marketplace on or before expiration. So, let's say a stock closes at $49. Some news comes out in the aftermarket. You're short the 50 call, and all of a sudden that stock is trading 53. Okay. Well, anybody who's long that contract can still exercise it up to their broker's cutoff period.
Mm-hmm.
So for OCC's member firms, for our member firms, we have a cutoff period of 90 minutes after the New York close in which that our member firms can choose to exercise their contracts. Now, keep in mind that 90-minute window is for our member firms. Now, your broker may have a lower threshold than that 90 minutes. I've heard of some notable firms where the exercise threshold is as little as 10 or 15 minutes after the close. So once again, you'll want to check with your broker as to what their exercise cutoff period is if there's a contract that maybe you want to exercise that closed out of the money, or maybe even a contract that closed in the money that you choose not to exercise because maybe because of aftermarket movement, that contract is now deemed out of the money. So,
right.
Yeah.
And so what you're saying, stock closes $49. I'm short a $50 call. Pardon me. After hours news comes out, stock is now trading 53.
Mm-hmm.
As the option seller, as the call seller, I'm expecting not to be assigned because stock closed at 49. But in reality, now that it's trading 53, and let's say you're the buyer,
mm-hmm.
you may decide to exercise that contract,
right?
Which you would need to do so manually because it did, in fact, close out of the money.
Yeah.
But now I'm all of a sudden at risk of assignment. And to me, the big risk isn't necessarily for an individual contract, but maybe even more so for a spread. Let's say I had that call spread on the $50. Let's say I had a $50, I was long a $50 call, I was short a $52 call. Now my long option theoretically is going to expire out of the money because stock closed at 49.
Right.
I have the right to exercise that at 50 if I choose to, but if I don't exercise that contract is going to expire out of the money. My short 52 strike call, I am going to be at risk of assignment. And if stock, so now I'm selling stock at 52. I'm short stock from $52, even though I expected to have no stock position whatsoever. Come Monday morning, stock's trading 53, 54, 55, what have you. I'm short stock from 52. I thought my risk was limited to my spread itself, but now because I was unexpectedly assigned on the short leg, my risk is now a short stock position, and who knows where that stock is going to be traded.
Correct. Right. So spreads, which many investors like to trade because they're defined risk characteristics, the defined risk characteristic of a spread only exists within the spread itself.
Right.
So an exercise or an unwanted assignment can throw the risk dynamics of that spread out the window should that happen. So, in that example, let's just say, you paid the stock's trading 49, you were long the 50, 52 call spread, you paid 50 cents for it.
Mm-hmm.
And it appears that the spread's going to expire out of the money. So you do nothing. But to your point, you can still be assigned on that short 52 call at any time up until the exerciser's cutoff period. Okay. And we see this all the time where news comes out and somebody who's long that call can choose to exercise it and sell stock in the post market and lock in a risk-free profit. Okay. You won't find out that you're going to be assigned until Monday morning. So you could very well wake up on Monday morning short the shares with all the risks associated with being they could short the shares.
Right. While you had expected to wake up with absolutely no position whatsoever.
Yeah. You expect the most you're going to lose is, say, the 50 cents that you paid for that spread, but now you're naked short the stock, and stock, you have all the unlimited risk that being short shares
that goes hand in hand with short stock.
Correct.
Right. Gotcha. Excellent. Very insightful information, Ken. Thanks so much for joining me once again to talk about options. This was fun. Thank you.
Yeah, I'm happy to be here. I look forward to speaking with you again.
Yeah, absolutely. To my listeners, thank you so much. Before we sign off, I want to invite everyone to send us your questions to be featured in a future segment of OIC's Wide World of Options. You can contact us via email at options@theocc.com or live chat with us on our website, optionseducation.org. And while we'll respond to your questions directly, we also might share your question with our listeners in a future podcast. So thanks again to all those listening. We'll be talking with you again very soon. Take care, everyone.
You've been listening to the Options Industry Council's Wide World of Options. If you have questions about anything you've heard on today's show, email options@theocc.com or visit www.optionseducation.org and chat with OIC's Investor Education team. Interested in connecting with OIC on social media? Subscribe to the OIC YouTube channel, like them on Facebook, follow them on Twitter at options.edu, and follow their page on LinkedIn. Thanks for listening, and be sure to tune in to the next episode of Wide World of Options.
You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.